The start to 2022 has been full of surprises. From a peak to trough sell-off on global markets, we've seen markets correcting, we've seen many of the growthier names on the stock market down by 20, 30 or 40%. There's been a bounce from the bottom, but investors are wondering, is the market correction over? And most importantly, what happens next? Today, I thought it was worth us doing a point-in-time discussion about some of the key economic data points that we've had come through over the past month, from economic recovery discussions to CPI inflation, the jobs report, as well as the earnings season that we're right in the midst of. Looking at the data, looking at the information that we have on hand, it can give us an insight into the range of possible outcomes moving forward into the rest of 2022. If you do enjoy the video, don't forget to hit the like button, make sure you've subscribed and turn your bell notifications on, and drop us a comment and let us know what your thoughts are on where the markets head moving forward from here. As we can see here, having a look at the current state of play on the S&P 500, the price action has been interesting to say the least. In terms of the velocity for the sell-off, it was fairly swift and sharp. Of course, we've seen a slight movement from the Federal Reserve in terms of the hawkish tilt that they've been providing with their meeting minutes. Of course, we had the first meeting for the back end of January, and we'll talk about where the monetary policy stance sits for the Federal Reserve and other central banks around the world later on in this video. We can see the market correction from peak to trough at the moment has been over 10%. We're officially into correction territory on the S&P 500. The NASDAQ is deeper than that, with many of the technology names experiencing the largest sell-offs, and the ASX down by 12% as well. However, we have had that recovery. We can see here there was a bounce. But investors are now wondering, are we going to be putting in a lower high, and is this the start of a more protracted bear market potentially, or a shift in trend? Or are we just getting a bit more structure into the charts before potentially having another go at the next leg up moving forward? We can see here we're trading in and around this critical 200-day moving average. The horizontal line, of course, we can see we've tagged this level previously over these moves over the past couple of months. So it's a key level, it's a key area, and of course with earnings coming thick and fast and plenty more to come over the rest of February, there's a range of near-term catalysts that are worth being cognizant of. So I guess as we make our way through this video and some of the key factors that are feeding into the market's price action over this past period, it makes sense for us to start really at one of the most important aspects of it, the economic recovery. Of course, a strong and robust economic recovery has been what's been underpinning the strength of the markets around the world. And really, if we cast our minds back to March, April, May 2020, just a couple of years ago, not even the most aspirational of economists would have forecasted we'd be where we are today. Granted, there's been a significant amount of coordinated fiscal and monetary policy support that's been underpinning this as well. But we have to give credit where credit's due, and the economy and the recovery has been much more robust than initially anticipated. This really fed into some recent jobs reports that came in on the US market on Friday's session. Consensus for new added jobs was around that 125,000 mark, and there was a huge beat to the upside. As we can see here, over 450,000 jobs were added in January, but this was actually built on top of a number of upwards revisions for previous months as well. So we can see the US economy is in a really good position. Unemployment rate ticked up a little bit higher, back into the 4% mark, but this of course was on an increased participation rate. And I think what's important as well, if you just look around anecdotally, around businesses, potentially where you work, or potentially at some of the articles or publications you've been reading, businesses at the moment are focusing on retaining as many workers as they can. Demand is evident across the economy, across a range of sectors. Of course, we've seen significant demand for goods all the way through the pandemic, as people have had a lot of excess money with the liquidity that's been pumped into the system. Savings rates have gone up. There's been significant demand for goods. But as we open back up, now demand for services is starting to flow through as well. So demand is not the concern. It's the supply side that's been the challenge. Of course, there's been worker shortages, which have been amplified by the Omicron variant and the difficulties that has brought out. But there's also been raw material shortages as well. I know just anecdotally, I personally work in management consulting, and at my firm, we've got a huge amount of jobs ads out at the moment, as do many of the other firms as well, playing in the similar type of sector. There is a significant amount of referral bonuses and interest from companies, whether you read about hospitality or retail or any of these sectors. Workers are wanted broadly across the economy, and this is pointing to a strong and robust economic recovery. Of course, the market and economists are now watching for sustained wage growth to follow. We've got many of the building blocks that the central banks were searching for. Of course, initially they wanted growth to return, to see inflation sustainably in that 2 to 3% band. Now we've seen a tight labour market that's continuing to get tighter, and now wage growth is really that final piece of the puzzle. Australian unemployment potentially below 3% for the first time in 50 years. No one was really anticipating we'd be saying that, even if you just look at the forecasts over the past couple of years. They've come down from 6, 5, 4%. And now there's a possibility that we see a 3 handle in front of it. I think all of this just builds into the fact that there is the opportunity and we're really looking at a strong and robust economic recovery. And now central banks and of course governments around the world want to make sure that they can keep this going, that they don't inhibit this, but that they can really help to really facilitate this economic recovery for years to come. But no matter how robust the economic recovery is, of course, the market is still made up of buyers and sellers, and the value that individual investors and traders are attributing to companies and shares on the market. So investors are not going to be willing to pay anything, despite what we might have seen in 2020 and 2021, those lower growth environments where there were certain sectors of the markets that investors were almost willing to pay anything for. We know that valuations have become elevated and stretched over this past period. We're well above the long run average. And there are contributing factors to this. We know that multiple expansion happens during periods of economic expansion, like we've seen out of the GFC over the past 13 years. Of course, periods of easy money, a hugely expanded Federal Reserve and other central banks' balance sheets have contributed into this. And along with that as well, we've seen record low interest rates, which, as we've all talked about on the channel before, interest rates almost act like gravity for the markets. The TINA thesis has been well and truly in place with there is no real alternative at the moment. So a lot of the funds have found their way into investments and through to the stock market as well. As interest rates rise, obviously the discount rates used for the discounted cash flow analysis will start to creep upwards as well, which ultimately will mean the present value is going to be worth less as the future value cash flows are brought in, which is going to start to challenge these valuations. And we've seen this already. Rising interest rates have been challenging higher PEs, which have been first and foremost in those growth end of the market. And as a result of that, many of the technology and growth names are down by 30, 40, 50, 60%. But of course, across the market as well, we've started to see a bit of multiple contraction. It's worth noting that not all sectors are made equal. We are starting to see a delineation between some of these sectors of the market. The growth and value debate continues to have those discussions, but it looks like we've started to take some of the froth out of the top of the market. I think it's worth noting as well, of course, however, that valuations have 2 components to them. If we're just looking at price to earnings, of course, prices can come down, as we've seen over this past period with the correction. But of course, there's a second component to that as well, which is earnings. And so with that discussion surrounding earnings, we're right in the midst of earnings season. This has been a hotly anticipated earnings season. We're starting to come out of this crisis period time. We're starting to open up. But of course, there are some difficult comps as well over the past year-on-year mark as well. So investors are starting to see how can these companies that have been bid up over this past period, can they match up to those lofty expectations? Maybe those companies that have struggled, are they on the recovery path, or what's to look forward to? Having a look at the S&P 500 as a proxy of global markets, we can see that just over 50% of the S&P reports have come through to now, and 76% or nearly 3/4 of them have beat EPS forecasts. There's a nice breakdown here on the right that you can see here. At a sector level, industrials, information technology, healthcare, energy have been those with the highest level of beats above. And on average, across the broader S&P 500 market, 8.2% have beaten estimates. This is about in line with the long run average, so we're trading pretty well. And I do think it is worth noting that, as we talked about before, PE ratios are beginning to come down over time with the correction as well as earnings growth. They are still elevated. It's not to say that they're back in line with their long run average, but they are starting to come down. And so the question is, how much further is there to go? And which sectors of the market are probably going to be the most exposed to that? And I think when we're thinking about earnings, of course, there has been some significantly fascinating reactions to earnings over this past period. Meta comes to mind, the biggest single day wipeout that we've seen on the markets. They lost over $200 billion of value. It was a huge sell-off, over 20%. While Amazon, the day after that, saw a significant uplift in their share price after beating well. And we've seen many of these mega cap technology names trading like penny stocks at times in terms of the volatility. We saw Snapchat as well with a significant uplift. Of course, Apple and Microsoft had some pretty strong and robust earnings as well. But I think it's also worth noting, just as a bit of a thought exercise, that share price responses to market earnings are not only a function of how well the results are. It's not, okay, the results were good, share price goes up. Okay, the results are bad, share price goes down. It is a function of the expectations that were built in. So if there's lofty expectations, if there's a high bar to reach, then of course, even if you have good earnings but not great, you could see a sell-off or maybe just a stagnation in the share price. If you have very low expectations, maybe you're a sector that's been beaten down over this past period, but you actually come in not too bad or better than was expected at that lower end, maybe you see a rise. So it's worth noting that you want to see where the market's expecting, how lofty are those expectations, and the easiest proxy of this is having a look at the valuation. Stretch valuations mean there's high expectations built into the price, and that's going to give you a bit of an insight into what the markets are really looking for with those upcoming earnings. And then I think another component that is important to think about, of course, is the monetary policy front. We all know how important this has been, and really central banks have been a key driver of the trajectory of markets over this past period. We're all familiar with the ultra loose monetary policy environment. It really has been a crisis time environment, but of course, we are starting to see the tapering coming through and a move to a more normalized conditions. US CPI inflation has got a 7 handle in front of it at this stage. Of course, all eyes is going to be on the upcoming January print, which will be coming forward in the next week on this upcoming Wednesday. It's going to be an important one, but I think what is important to distill down is the differences in inflation that you can have with different periods. You can either have a demand-driven inflation, which of course where demand is getting too hot, but there is of course the supply side inflation as well, which is more what we're likely seeing at this stage. Of course, the balance of which side of the spectrum the inflation is coming from is going to be different. Every economist, analyst, investor is going to attribute different portions of the inflation to different sides. But we know we're seeing supply chain bottlenecks and materials and worker shortages. So central banks are hoping that over the next 6, 12, 18 months, as the effects of the virus and the lockdowns fade and we see a more normalized society, hopefully many of these supply-driven inflation factors are starting to come down and we might see maybe a bit of moderation inflation. The Federal Reserve, however, needs to be seen to be acting towards curtailing this inflation. Even though that is the hope towards the back end of this year and perhaps into 2023, they need to be seen to be acting. And so they've given us the roadmap. They're, of course, tapering the bond purchase program by $30 billion a month now. Of course, looking forward as well, the market's starting to price in rate rises. Looks like March could be the first one, 3, 4. Now we're starting to see potentially a 5th rate rise priced in. And so all eyes will be on what happens to the market moving forward while they don't want to inhibit the recovery. We know the focus has been on not taking away the Kool-Aid too early. They want to make sure that they give this recovery every chance of having the best steps forward. So that's the balancing act that they have. I think feeding into that, however, is that the market has been beginning to price in a more hawkish Federal Reserve. And this gives the Federal Reserve optionality. The market started pricing it in, so of course, if it's pricing in more of a worser case scenario, that means that if the Fed surprises to the upside, maybe they only do 2 or 3 rate rises if inflation starts to ease. Well, that actually gives them the opportunity to have that optionality. That's what the central banks around the world really are looking forward to as they start to see, okay, how does this recovery go? But how does this inflation narrative play out over the next period? And so, of course, the final question is, what happens from here? Before we get into that, if you've enjoyed the video, don't forget to hit the like button and make sure you've subscribed and turn your bell notifications on so you won't miss any of those daily episodes. I think this inflation discussion is going to be at the first and foremost of investors and economists' minds, as we've talked about. Will it peak and then begin to decline? Of course, it's worth noting that there are uncertainties that continue to persist on a macro front, on a virus front, and on a geopolitical front as well. There's plenty of uncertainties, and all of those have the ability to have potential implications and flow-on effects to the market. I do think most people have looked at this period as a much needed correction to take the froth out of the market. Of course, there's going to be divergent opinions on whether this was enough or whether this is just the start of a broader correction or potentially a crash, or if this was it and maybe we can have our go at the next leg forward. But we had started to get a little bit ahead of ourselves, and so of course a correction can always be healthy. I do think that whatever happens moving forward from here, volatility is likely to persist one way or another. We've seen that with some of the swings over this past period. It is worth noting too that markets can move higher during rate cycle periods. Often there's wobbles, often there's uncertainties. Of course, we want to avoid the taper tantrums that we've seen before, and they are often volatile periods, but the markets can move higher, particularly around that first rate rise into the back end of the cycle. And it is worth noting too that markets are still relatively fearful currently. Of course, this past week of earnings has really stimulated and catalyzed a bit more support for the markets, but before that, there was a fair bit of uncertainty surrounding. And underpinning all of it, This was the trajectory that the Fed and central banks forecasted for the economic recovery. They wanted to see inflation in that 2 to 3% band or above that sustainably. Obviously, it's above it, but it'll be interesting to see how it moderates. They wanted to see a tighter labor market, and they wanted to see wage growth continuing to grow to 3%. We'll see where the market heads. It's a very interesting time. It looks like 2022 is positioned to be quite a fascinating one, to say the least. Of course, volatility can bring opportunities, so that's what a lot of investors are looking forward to. I'd love to know your thoughts on it all, so drop in a comment below. Let us know your thoughts. And as you guys know, I'm just a bloke on the internet who loves talking about the markets. I'm definitely not a financial advisor, and nothing we discuss is financial advice. Hopefully it's an interesting starting spot for your own research though. We'll leave some videos up above that you can check out after this one. Thank you so much for joining us. For now, stay well and happy investing.